Welcome to the weekly update. This is being prepared over the weekend of July 23rd and 24th, where we'll look at the action in the market over the past week and then see how things look for July 25th through the 29th. And we had an up week. We had some economic reports come out that were a little weaker than expected. That seems to have helped interest rates to fall a little bit. We saw some of our scenarios that I've been going over in the videos. They're picking up some steam and looking a little better, even though Friday did a little bit of damage to the technical picture. But overall, we're looking better. On a weekly chart basis, we're still negative overall, but we're starting to see some positive little glimmers here and there, and I'll point those out. So let's go back and talk about the week session. The economy continues to show slower growth, and I'll show you that on another slide coming up here. The S&P was able to reclaim its 50-day moving average on the daily charts, and on Friday was actually above 4,000. Now, we fell back below that, and we ended up being down on Friday, but at least for a little while, we were above 4,000. And people like to talk about that. It's a round number. Everybody thinks it's wonderful and great. Well, when we fell back below it, suddenly they weren't singing that same tune. We also heard this past week where Apple, Google, Microsoft, and Snap, some of the big companies out there, they're going to start slowing down their hiring that we've been seeing. Even though the employment situation has been holding up rather well, now we're starting to see some cracks in that. And when big companies like the tech companies like Apple, Google, Microsoft, when they start to slow down their hiring, that sometimes can have a ripple effect throughout the entire economy. Interest rates ended up declining, which is kind of strange because if we're in a really high inflationary environment, why are interest rates coming down? And I'll show you the chart of that. We still have the 10 to the 5 and the 10 to the 2 yield curves that are inverted. The 10 to the 2 is the one that people pay attention to the most. We're also watching the 10 to the 3 month. You have some economists who don't think we're going to go into a recession, and they're citing the 10 to the 3 month. Well, it's been dropping and dropping and dropping and in danger of going inverted. And if it does, you'll have a lot more economists jump on board saying, yeah, we might be going into a recession. Then in Europe, what happened? They raised interest rates for the first time in 11 years at the European Central Bank. They had expected rates to be raised 0.25%. So that kind of spooked and freaked out the markets when they ended up raising them 0.5% instead of the expected 0.25%. The Bank of Japan, they also met, but they left their rates unchanged, and they're kind of going through different things with their economy. They've got some other problems that might work their way into the global structure of things, but right now they're more self-contained just within Japan, but that could change in the future. So for the week, we ended up being up 2.55%. Volume was below average, and that's what we're starting to see now. We did have an above average day on Thursday, and we had an advance on that day. But most days, even whether they're up or down, we end up seeing below average volume. The technicals on the weekly charts, they're still negative overall, but we're starting to see some shifts, and I'll point those out. The big deal right now is inflation and interest rates. We have the whole list of geopolitical concerns: Russia, Ukraine, China, supply chain issues. I don't have it right here, but there's some potential political instability happening in Italy right now, where they had their prime minister resign. Then they said, oh, no, you're not. And then that seemed to be okay. And then I think it was on Friday, the prime minister ended up resigning either Thursday or Friday last week. We just don't want to see any real political instability. There's enough economic instability right now. So this is kind of influencing the European central banks potentially, where maybe they want to raise interest rates and they really don't feel that they can, even though they did it stronger than expected. So that can add a bit to the instability of the markets in Europe, which sometimes can bleed over into the US markets. We also have earnings that are starting to come out. And then the big deal right now is recession fears. Our trend is negative and it's getting stronger. And I'll show you the chart for that. Here are the economic reports. We had the NAHB housing market. That index had been at 67. It came in this past week at 55. That's quite a pretty big drop, and not necessarily a real big deal. I read one report that the market tanked after this report came out. I don't know about that. I think the market wanted to go down anyway, and this just happened to happen. They just happened to release this at about the same time. Housing starts and building permits. Now, building permits tend to be a leading indicator because you have to have a permit before you can start building. But the housing starts, starting new home construction, that was weaker than expected. So we're seeing a bite into the real estate area. Existing home sales, that came out this past week. They were weaker than expected. Initial jobless claims, that was greater than expected. So more people are getting laid off. They expected right around the 240,000. This came in at 250,000. And the Philadelphia Fed index, it had been at minus 3.3, where last week it came out at minus 12.3. Leading economic index, it decreased. It was down 0.8% overall. So see, all of these are showing just a weaker economy. And the preliminary IHS market manufacturing, this isn't the real big one, and it wasn't really that important in and of itself. It had been at 52.7 and it fell to 52.3. But the one that kind of shook people up a little bit were the services part of this report, where it had been at 52.7 and it declined to 47. Now, when we drop under 50, that is considered to be a contraction in the economy. When we're above 50, it might be slowing down, but at least it's growing at that point. So they're a little bit concerned about that. Here is the intraday chart going back to Monday, where we gapped higher on Monday and things were looking pretty good. And then we just kind of went downhill from there. They're citing that some of the weaker than expected reports is really causing this. I don't know about that. We had a gap up on Tuesday and then a really nice advance. And then we kind of chopped sideways with a slight more advance on Wednesday. Then Thursday, we had a really nice run up. So we saw 3 back-to-back up days in a row. Well, then on Friday, we gave some of that back, not quite 1% overall. The Dow was up 2%. The NASDAQ up 3.3%. S&P, as I talked about, it was up 2.55%. And the small caps were up 3.6%. We want to see some growth in the health in these small cap stocks, because there's some reports that have been looking at showing that small caps are considered to be undervalued. And if people might be willing to deploy some money into the small caps, that will boost them up. And a lot of times that will bleed over into the other indexes. Here's going back just through for the week, how all the different indexes performed. You had the NASDAQ 100 being the strongest at 4.37, and the Dow, it was up, but 2.66%. Then we go back to the all-time high. How far have they dropped since then? The Dow has held up the best at 13.32. And then way over on the right-hand side, you have the NASDAQ, which is down over 24% since the all-time high. In the S&P, looking at our sectors, discretionary did well, materials, industrial, energy, tech, all of those sectors were up. We only had 2 sectors that were down for the week, and that was the healthcare sector and the utility sector. Some sectors that have been seeing a little bit more love in 2022, especially utilities, but they've been kind of wavering a bit. This is going back over the last week, looking how the sectors were. Discretionary, the one that's been taken out and shot the most this past week, this past year, it did the best over the past week, where all of the sectors were up and we had utilities up 0.93%. Here's our current market valuation. We're still at fairly valued right now. This is the overall score for all their different charts that they look at. And we're a little bit above this dash line, which when we're above that line, we're overvalued. When we're below that line, we're undervalued. Well, when we get up to this yellow area, that's when we're really starting to get overvalued. We've been coming down off of that, and we're getting more down to the fairly valued area. This is the Buffett indicator, which takes the price of stocks and looks at them against GDP. And it shows that we've been really coming down right now, and we're getting back into a fairly valued area where it did blip up a little bit over the past week. This is looking at the historic average of the PE ratio, and that's the dashed line. When we're above this, we're considered to be a little bit more expensive. When we're below this, then we're inexpensive. Well, for about 11 years, we're overvalued when it came to the PE ratio, and we've been coming down, and we're getting closer to a fairly valued reading for that. This is taking margin debt. Now, we've been seeing that really decrease, whether folks had to stop using margin because they got burned or they don't want to buy stocks on margin, what have you. We're seeing that really decrease right now, and it's actually getting to an undervalued reading. That could potentially be positive for the market because you have some built-in funds here that might be available for purchase. And the folks that do like to buy on margin, they can, in essence, double their purchasing power. So that's kind of sitting on the sidelines. And if we really get screaming to the upside and you have folks that only go long in the market, that could really help give some support. Here is the historic trend line over time of the inflation adjusted value of the S&P, where it's been going up over time. We really got far away from this, but we're starting to come back down closer to the historic trend line. Looking at sentiment after Friday's session, we were at 3.9, where we did get all the way down below 25, and then we saw a bounce up out of that. Here is the historic chart, just showing how we bounced up and we're falling back down a little bit. We're kind of working our way more towards neutral currently. Here is the spread between the risky loans like junk bonds and the not so risky loans like treasury bonds. And they measure the spread between the two. And when this is going up, that means the spread is really widening. And this could be really bad for the economy. Well, it's been going up, but in our latest reading, it's now been coming down a little bit. This is the National Financial Conditions Index, where, yeah, it's been going up, but we're still below this black line currently. And oops, I hit the wrong button there. I'm hitting the wrong button continuously here. This is the same chart, only inverted. So back here, we had the National Financial Conditions Index. The black line, it's the same chart, only flipped upside down. And it's comparing it to emerging markets because they have to use a lot of borrowed money. And so when this is, in essence, going up, that means that emerging markets are going down, but they're trying to make some kind of a correlation between the two happening. And they tend to move, when on an inverted scale anyway, they tend to move together. They tend to have an inverse relationship when you plot this according to its normal way of plotting. This, I don't know how helpful this would be. This is the Dow compared to the Fed funds rate. And the Fed funds rate is inverted as well. And it just shows that they have a tendency to move in opposite directions. This is showing how flows of funds have been really coming out of stocks, but it's showing how a lot of people are really, that's the light blue line here, they're getting out of their stocks. And this is the 12-week average of that. And it's just showing how the average is also coming down right now. This is kind of a freaky chart here, where if you look where we're at right now, we're kind of in the middle for the first quarter. Well, you see most of these blue dots, they tend to be over on this end. This is suggesting that maybe we're overvalued right now as far as the S&P is concerned. I don't know. I don't use these charts a lot, but some people seem to like them and think they're pretty. This is just showing that housing bubbles, what goes up must come down, just like a lot of things in life. We're starting to see housing prices really start to come down. Yeah, try to say that to yourself if you're trying to buy a house. And here's also showing how housing prices on a nominal basis, that's more what the real price is. And then the real basis, they're taking inflation into consideration there, where they're expecting housing prices to continue to fall. This is trying to make a comparison between 2008 and 2022. I don't know if I buy into that all that much. Yeah, you can see that on this chart when it comes to the stock market having trouble and volatility. There's a lot of differences based on what I've done to study things that happened in 2008 and where we're at right now. There's some similarities too, but there's also a lot of differences as well. They were both bad times, but we still have half of the year to see if 2022 can redeem itself. This is just showing when there's more credit out there and credit really starts to rise. This measures the Euro real estate investment grade bond spread. When it starts to get wide, that means there's more risk going on in the markets. This is, yeah, inflation causes recessions. You have the treasury yield really going up, and you have the bank industry group, which is part of the financial sector, been going down. They're moving in opposite directions where they tend to move in the same direction. And that might suggest we're heading towards a recession. This is kind of a really funky looking chart with all these lines over here. Looks like rainbow spaghetti. But we have the red line here is 2020. That's as far back as this chart goes, where we saw the massive, and this is also inverted just to make it even more confusing, where we saw the real big increase in unemployment. And then it's been coming down, down, down. And this is where we're at right now. This is just to compare it to other time frames. The right X bear bull ratio coming down a little bit. Some folks are starting to get more into the bullish funds. They're seeing things a little more positive since the last time we got a reading on this chart. AAII, after giving us an extreme negative reading, we're starting to bounce up out of that. So you have individual investors. They're still negative on the market, but not as negative as they were. The VIX declined on a weekly basis, both on the line chart and on the bar chart. And the Ulcer Index, I've been showing this in my daily videos because I think this is more of what's going on a day-to-day basis. This measures fear, and we've been going up, and now we've been starting to come down, where the daily chart has us way down here below the moving average. And I just don't think that's very realistic right now. Copper has been continuing to fall. That sometimes tells us what's going to happen in the economy. It's really falling, so it's suggesting economic weakness in the future. Here's our scenario that we're watching, where we saw the equity put call ratio of the 5-period moving average. It spiked up and has been coming down. It's been coming back up now because we had some down days, or at least Friday was, but we're still watching this. And if you look at other times, this is a daily chart. This sometimes marked a significant bottom in the S&P 500. This is the sector rotation that we're watching. Even though we saw, again, on a daily chart, saw some weakness on Friday, the Qs against the S&P 500 are still doing better. This is kind of the surprising one, where we saw discretionary. It actually did okay on Friday. The large cap growth against large cap value, we're seeing that start to decline. Again, just to remind you, back in 2021, we saw the exact reverse of this. We saw the S&P making higher highs. Well, we saw a rotation going from growth stocks into value stocks, and that's partly what led to this whole terrible 2022 that we've seen for the first half. Now we're starting to see the inverse of that, where the smart money is starting to get back into growth stocks. And we're seeing it by looking at these sectors and doing ratio comparisons between them. Here's another chart showing growth against value with large caps still holding up above the moving average, mid caps and small caps. They're all, they turned down because we had a down day on Friday, so we took a bit of a hit. But what we're really watching for is, can we stay above this moving average? And is the moving average itself actually going higher? Looking here at the PE ratio, where it still shows with the Shiller PE ratio that we're still very overvalued. And this looks back, and this also takes inflation into account, where as the market goes up, this gets a little more expensive. We should be around the 16 to 17 level, according to this chart. This is a fact set, and I have another chart right after this, but it just shows that second quarter earnings, it continues to be weaker than normal. And as of the time of this article, 21% of the S&P 500 companies have reported. Of these, 68% of that 21%, how do you like that? They've reported above estimates, which is below the average of 77%. I mean, my gosh, how many numbers can you have thrown at you and not freak out here? So in aggregate, companies are reporting earnings that are 3.6% above estimates, which is also below the 5-year average of 8.8%. My goodness. Yeah, they can throw numbers at you and just make you want to jump off a cliff. Here is a chart. Right in the middle here, we have the S&P, which is just showing how we're doing compared to other sectors right now, where we're around 68 to 72% or so. And this will change as more reports come out. This is showing that reporting year over year, there's a decline in the net profit margins for the second straight quarter. We were down with GDP last quarter. Now, it doesn't really show that, because right here where I'm right here where I have the cursor, that's what they're talking about. Does this look smaller than this? No, I don't think so. So they tell you this in the headline, and then they come out with a different number that says, well, wait a minute here. We have an estimate of 12.7% going on right here. So yeah, kind of whatever thing here. So I'm sorry, 12.4%, but that's higher than 12.3%. I mean, I'm not that good at math, but I know that that's a higher number. So again, there's a lot of manipulation that goes on with this information. I'm not saying FactSet does that. I'm just saying if you look at the headline and you look at this chart, you're kind of getting two different answers. Here's the current earnings estimates right now. Based on Morgan Stanley and where they see things, they tend to be lower than the rest of the crowd. Now, Fed Watch, this is what's interesting. We have the Fed meeting this coming week, and right now there's an 80.5% chance that we're going to be at 2.25 to 2.5. That's a 75-point basis hike from where things are at right now. Remember, a few weeks ago, we were up over 90, and then some strong economic reports came out, and we just went boom, almost down to 50-50, with that between 3/4 and a full percentage point rate hike. Now, with this weaker set of economic reports that have come out, we're seeing that start to go back up. There's no economic reports coming out on Monday. There's a few little fluffy ones on Tuesday. So unless something really big happens outside of economic reports, this is probably about what it's going to be. And the Fed should be doing what it says on this chart. They're supposed to follow the market. Yeah, I know. And everybody hangs on every word of the Fed. It's really strange. Here is the latest Fed balance sheet showing it starting to decrease ever so slightly. This is the weekly chart showing that we were down a little bit based on price and volume with the advanced decline line. And here is showing the advanced decline line ratio where it also started to decline. So we're not seeing a lot of positive right there yet on the weekly chart. We're not really seeing anything positive with the new highs and new lows yet. Accumulation distribution, it turned up a little bit, and we're just barely starting to go above the moving average. Here's our trend. The ADX is starting to roll over, but it's still above the moving average with the red line on top, so that means that we're negative. This looks more positive on the daily chart, but it's just showing how the oscillator between the red line, which are sellers, and the green line, which are buyers, it's starting to show some improvement. The mass index, this is interesting. We were waiting for this. When it goes above 27, that's the first part of the signal. When it comes down below this red dash line at 26.5, that's the second part of the signal. This is telling us something big is going to happen. It doesn't necessarily tell us in what direction. Now, if you're looking at some of the other charts, you might default to the upside, or if you're more negative on the market, you might default to the downside. But this is just suggesting something big in the as far as market movement can be expected from here. All right. We had a bit of a change with the decision point scorecard back on the 19th. We had the trend model switch back to positive in the short term. Here is the daily chart showing the pivot points. We came right up to S1. Isn't that interesting how these little lines really mean something? And then we bounced back down from that as well. Down at the bottom, you can see where volume was below average for the week. We're still below the 50-period moving average. We're still in a downtrend, but we're starting to come back up to this 50-period moving average on this chart. I'm sorry, the 13-period moving average. The BPI showing a lot of improvement, and we broke above 50. So this is now positive. The Chaikin oscillator, it's going up and showing a lot of improvement right now. Chaikin money flow also showing some improvement. It hasn't quite switched positive yet, but the histogram is starting to come up. The force index also showing some improvement. McClellan oscillator above 0 and advancing. That's positive. So the summation index is going up based on price, and we've just crossed over 0 based on volume. And we're seeing that on the daily charts too, where this move up that we've seen seems to be led by volume right now. And that could be really positive for the market. All of our oscillators continue to be negative. Some of them are trying to turn up, like the slope and the MACD. We have the TSI just barely trying to go positive right now. You know, with weekly charts, I'm not a big believer in these oscillators, but some people still like to look at them. With the Swinland trading oscillator, we're positive based on price and volume. So that's positive right there. The percent of PMOs that are rising, we're starting to get a little extreme there as far as the buy signals, and we're turning up with the PMOs that are above zero. So that's showing some improvement. The RSI, it's still below 50, so that's negative, but it is advancing, so that is positive. Special K, this is a long-term indicator. It's still continuing to roll over. And then we already showed this one. Here's the Stochk RSI, which is showing that we're extreme positive right now. The Williams percent R is also showing some improvement. The Vortex showing a little bit of decrease with the selling, a little bit of increase with the buying. The Ultimate Oscillator, just barely above 50 right now. So that's slightly positive. Money flow above 50 and advancing, so that's positive. Bollinger Bands, not quite up to the dashed line yet, but is advancing. KST continues to be negative, and the PPO, this is possibly looking to turn here. And a lot of people use this indicator and really rely on it. Here's the rate of change going back 1 week. We're pretty much neutral with that. And we're showing a bit of an advance going back 50 weeks. Copic curve starting to turn up, but not really giving us any kind of a signal right now. The weekly chart, we're still above this support where we've been dancing for the last month or so. Can we stay above that if we start to go down? Can we break above and deal with some other resistance if we continue to go up? Our charts, the Heiken Ashi is still looking positive. The Kegi, it turned to positive this past week. The Renko, it's still negative. The ease of movement is showing some improvement, although we're still below zero. The point and figure chart, it drew in some X's this past week, and then we're getting a triple top breakout. And that happened back on the 18th. So this is fairly positive. The three-line break is still looking negative. So see how we're getting kind of a mixed picture right now? Elder Impulse is still neutral. The parabolic SAR still is negative. So looking at the broad market, here's the S&P, which has shown the decline when we're starting to bounce back up. Mid caps showing some improvement, and small caps as well. Here's our all stocks. They turned up this past week. Can we get back up to this moving average? Mid caps also, they got up to the moving average. That could be positive, but we're still in a negative, or still in a downtrend overall. Small caps here also still in a downtrend, but showing some improvement. The Dow, same thing. The NASDAQ, we're above the moving average. And again, that's what we're looking at for leadership if we're going to see a real rotation back into growth. Here's the NASDAQ 100, same thing, above the moving average, looking to it for growth, or looking at for it to go up because it's growth. NYSE hasn't quite got back up to the moving average yet, and we're still in a downtrend. The Wilshire is just at the moving average to slightly above it. The FANG stocks, they had a decent week. They were up over 5%. ARK was up almost 5% and showing some improvement. Here's the biggest software company still in a downtrend overall. Here is Dow theory. So we can see how the Dow has been kind of following the same track as the transports. Well, we've been seeing some strength in the utilities, and then some weakness, and then some strength. Now they're starting to show a little bit more weakness right now. Now that's technically not part of Dow theory. Dow theory, from the way I understand it, is mostly the Dow and the transports, comparing those. I just throw the utilities into the mix as well. Looking at the CRB, see how it's really starting to come down now, but it's still in an uptrend, but it's starting to show some weakness. Gold is just not doing very well. And on the weekly chart, as well as the daily chart, we're seeing a death cross here where we've seen a death cross already on the daily chart. Silver is also having a lot of trouble right now. Oil down below 95 even. The dollar, which got hit a little bit. And if we do see stocks go up, and I've said this in the daily videos, we might see the dollar come down because stocks like a weaker dollar. And so if stocks really get set to go up, and they're almost acting in an inverse relationship right now. So if stocks go up, that means the dollar's going down, and the inverse of that is also true. So if you want to keep an eye on something, watch the NASDAQ and then watch the dollar. Also watch staples, and I'll show you that here in just a moment. Here's the bonds where we were up over 1% for the week with the ETF. This is what I'm talking about internationally, where you're seeing interest rates really coming down in the US, UK, and in Germany. Japan's kind of its own deal right now. But if they're really worried about inflation going up, why are these rates going down? That doesn't really make any sense. Now, they could always turn around and go the other way, but it's like the bond market is sensing something that maybe other folks are not sensing right now. Here's our relative study showing bonds are still trying to outperform a little bit, and we're seeing a recent golden cross here in the ratio between bonds and stocks. This is stocks and bonds with a monthly chart where we're seeing bonds show a little bit more strength, but overall, stocks are still in the uptrend. Here's our intermarket analysis chart showing how oil is still up over 35%. And then the dollar is in second place, where you have gold, stocks, and bonds. They're still down going back to the beginning of the year. Here's the gold to dollar ratio showing how as the S&P goes up, or excuse me, as the dollar goes up and gold goes down, that's what makes this line really go down. Here's the gold to the S&P showing that the S&P has been actually outperforming gold lately, but gold is still in an overall uptrend. Here's low volatility, the stocks that people like to get into when we're having trouble in the market. It's still in an overall uptrend, but showing some recent weakness. And here's growth against value. Also, growth is still in a downtrend, but could be starting to bounce. Here's the NASDAQ 100 growth against the S&P 500, which is more value, even though there is growth in the S&P. The NASDAQ 100 is in an overall downtrend, but starting to show some improvement. Here's the S&P 100, which is mostly growth against the S&P 500, still in a downtrend, but really saw a nice bounce over the last few weeks actually. Discretionary against staples in an overall downtrend, but could be advancing. Energy against the tech sector, and then the ratio between them shows how energy was really going up, and now energy is really starting to underperform tech. Our scenarios, we're still watching this. We have the percent of S&P 500 stocks above their 200-day simple moving average. We gave almost an extreme negative reading, and we're still bouncing up out of that. Here's another one, looking at the 10-day average of the highs and lows. That's causing a little bit of concern on the daily charts. Even with the advance this past week, we did not see a corresponding rise in the new highs. We didn't even, well, except for Friday, we saw a little bit of new lows, but we're not really seeing anything right now because we've been bouncing around in areas where we've been before. So this indicator isn't moving as much as the market is, at least right now. If we break to the upside or break to the downside, then this thing will really start to move. Here is the S&P 500 with those stocks above their 50-period moving average, and it continues to advance. We're seeing that in the mid caps and in the small caps as well. So we're seeing confirmation with these other indexes. The small caps against the S&P, they were down a little bit on Friday, but they are showing a lot of improvement. Here is the chart. The red line is the ratio between the small caps and the S&P. The blue line is the S&P 500. Sometimes we see a little spike up like we saw here, and then that can give a little boost to the S&P 500. Here is the 2-year treasury. Also, sometimes when we spike up like we have in the past, that can give a boost for a short to intermediate term move in the S&P 500. Here's the staples. And this is what I say, watch this, because we have crossed negative. It's hard to see here, but this is a death cross. And where the staples had really been doing well over the last few years, they're now going into a negative trend. We want to watch that to see if this continues to drop, because right here, we may have created another spike in the last week, and we've really been falling down, even though we bounced back up a little bit on Friday. When you see a spike in this often marks a significant low in the S&P 500. Are we seeing that this time? That's the question that we're trying to answer. Okay, so what's our outlook then? On Tuesday, we have consumer confidence coming out. We have new home sales, some more real estate information. Wednesday, we'll get durable goods, and then the biggie is going to be the FOMC announcement. And again, they're probably going to raise it 0.75% unless something really big happens one way or the other between now and then. And there's only a couple of, you've got consumer confidence and new home sales coming out on Tuesday. And I guess they'll have durable goods coming out Wednesday morning, but then they make their announcement after that. Then on Thursday, we get the advanced report of the GDP and jobless claims. Friday, we get personal income and spending. Then PCE, that's a biggie. Chicago PMI, kind of big. And then the employment cost index, which can be big as well. And then the final reading with consumer sentiment, it's now at all-time lows. Is it going to show any improvement? That's what we're asking right now. So the technicals, yeah, they're showing some improvement on the weekly charts. We see some glimmers of hope, but we're still negative overall. We have all the things that I was talking about. And then the thing with Italy that's listed on here, we don't really want to see any instability in Italy. They're having some issues with their prime minister, who resigned and then didn't resign and then resigned again. We don't want to see that kind of stuff because it could bleed over into the US. All right. So we're not looking really at a down scenario. Well, we are looking at a down scenario now on the weekly charts for all the reasons that I just talked about. But the technicals are showing some improvement. And this is also based on the daily charts. We are not really going up yet because on the daily, we are below 20 right now. That's why I have the sideways trend highlighted. And so, but we're way above 20 on the weekly chart, and we're negative right now. So depending on what you use to make your decisions, whether it's the weekly or the daily charts, we're getting different readings right now. So thank you. Have a wonderful weekend and a wonderful week. I will be posting the intermarket analysis video, hopefully before the open on Monday, and I'll talk to you next week.